In this tutorial I'm going to talk to you about the classification of financial reports. So far you would have done a simple income statement and a simple balance sheet. Now we're going to go to the next step. Here's an unclassified income statement. What we have to learn now is to classify these expenses in three basic categories. First of all, let's look at our revenues. There's two different types. The one that go in the top part of your income statement, namely sales, from which we take the cost of goods sold, and once the gross profit is worked out, we have to then classify any other revenues that have been earned. For example, interest revenue that are classified in the other operating revenue section of the income statement. Now, in terms of expenses, it gets a little bit more complicated. We have our cost of goods sold as before. That hasn't changed, but in terms of our expenses, we've now got three different types. The first, selling and distribution. Anything that is to do with selling or distributing the product or good or service that we have sold, for example, advertising, selling expenses, delivery expenses, goes under this heading. The second type is the most common type. It's a general administration expense, where a lot of other, as I said, the most types of expenses go for insurance, rent, electricity rates, telephone, stationery. And the third type is the financial side. Okay, what costs have been incurred in financing business, and the two common ones are interest and bad debts. Now let's keep going. Here we have a classified income statement to show all those different classifications. You'll see it's a bit more complicated. We have other revenue up here. We have selling distribution expenses, general admin expenses, and finance expenses. So they're the three different types of headings that we now have to learn how to classify when we are drawing up an income statement. Assets. Now this is when we start talking about the balance sheet. So in the first instance, what sort of assets have we got? In the first instance, current assets. Current meaning in the current accounting period, which is 12 months. Any asset that gets transformed or realised into cash over the next 12 months gets put into this account, into this classifications. Examples: cash, accounts receivable, inventories are the most common ones. Then we have other top assets which we keep, or the businesses keeps for longer than 12 months. Example: equipment, land, motor vehicles, goodwill, just to name a few. Non-current assets are commonly divided up into three different types of classification as well. Other financial assets, for example, investments, debentures, property, land and buildings, motor vehicles and so forth, and intangibles. They're the assets that we can't touch, but we still have some sort of value, for example, patents, goodwill, and copyrights. Liabilities is another section which gets segregated into current liabilities, the liabilities that we have to pay back in the next accounting period, i.e. the next year, commonly bank overdraft, accounts payable, GST clearing, and the other classifications are non-current liabilities, i.e. the liabilities that we have to pay in the longer term, more than a year, commonly bank loan and mortgages. Let's have a look at a classified balance sheet. This is taken from your text on page 446. You notice up here we've got current assets. There's a whole number of those here. We then have non-current assets, and there's a whole number there, including intangibles, property and investments. We've got current liabilities, we've got non-current liabilities. The liabilities, the total liabilities, were taken away from the total assets to get net assets. So that's the difference between those two figures there. On the capital side, the owner's equity side, we've got that plus a profit less the drawings, giving us the final balance. So that balances with that, so it's okay. So there you have it, a classified income statement and a classified balance sheet. Thanks for listening.